The US dollar just hit its lowest level in 4 full years. The Bloomberg Dollar Spot Index dropped sharply throughout early 2026, with no meaningful recovery. Morgan Stanley, one of Wall Street's most powerful institutions, just made a definitive call. Their currency desk officially described the dollar as historically overvalued and heading measurably lower still. Morgan Stanley expects continued gradual dollar depreciation throughout the remainder of 2026 entirely. Their EUR-USD forecast targets 1.18, meaning the dollar loses clear ground against the euro. Rabobank independently published the same 1.18 EUR-USD target over the next 12 months. JP Morgan simultaneously turned bearish on the dollar while raising its 2026 recession probability significantly. 3 of Wall Street's most respected institutions are pointing in exactly the same direction downward. When Morgan Stanley, JP Morgan, and Rabobank align on a single trade direction, pay close attention. If Finance Insight is adding real value, subscribe to the channel right now immediately. Hit the notification bell and never miss another critical financial update from Finance Insight again. Now back to the dollar, because the reasons behind its decline reveal something deeply important. Understanding this dollar weakness requires looking at both the immediate triggers and structural causes together. The immediate trigger is the Federal Reserve's rate trajectory through the remainder of 2026. Rabobank projects the Fed cutting its policy rate toward 3% by year-end. Entire Deutsche Bank economists expect only 2 further Fed cuts before a pause in cuts follows. Either scenario pushes real yields lower, and lower real yields are structurally bearish for the dollar. When American interest rates fall relative to other countries, capital flows away from dollar assets naturally. Investors move money toward higher yielding currencies, and that capital movement weakens the dollar directly. But this dollar decline is not purely a rate differential story. It goes far deeper structurally. Morgan Stanley specifically described the dollar as historically overvalued, a term with precise technical meaning. Historically overvalued means the dollar's purchasing power parity value is significantly above its fair value estimate. Purchasing power parity compares what a dollar can buy in America versus abroad in real terms. When a currency is significantly above its PPP fair value, mean reversion becomes mathematically inevitable over time. Morgan Stanley's bearish dollar call is not speculative. It is rooted in this valuation framework precisely. The dollar has been artificially supported by high U.S. interest rates maintained through 2024 and 2025. As those rates fall toward 3%, the artificial support disappears and fair value reasserts itself. This process of mean reversion is what Morgan Stanley and Rabobank are forecasting throughout 2026 specifically. Now add America's fiscal position, because it is the most powerful structural dollar headwind of all. America's national debt stands at $38 trillion as of April 2026 with no reduction plan. The Congressional Budget Office projects that debt reaching $54 trillion by 2034 under current trajectories. Annual interest payments on that debt have already crossed $1 trillion for the first time historically. America now pays more in debt interest than it spends on national defense or Medicare annually. Persistent deficits of this magnitude are structurally corrosive to long-term confidence in any currency entirely. Every dollar borrowed to finance a deficit is a dilution of every existing dollar's future value. This dilution process is slow and invisible in the short term, but inevitable over the medium term. Morgan Stanley's dollar forecast implicitly recognizes this fiscal dilution dynamic as a core structural driver. The dollar's reserve currency status has historically insulated America from the full consequences of fiscal excess. But that insulation is measurably thinning, and the reserve share data confirms it with precision. In the year 2000, the US dollar represented 71% of all global foreign exchange reserves. By April 2026, that figure had fallen to approximately 57% according to available reserve data. That 14 percentage point decline represents trillions in deliberate reserve diversification away from American currency globally. Central banks do not reduce reserve allocations casually. These decisions reflect deep strategic recalculations over time. The recalculation driving dollar reserve diversification connects directly to America's unsustainable fiscal trajectory going forward. Reserve managers read the same CBO projections, IMF warnings, and Goldman Sachs debt analyses that analysts do. They see a currency backed by government borrowing $1 trillion every 100 days consistently. Their institutional response is to quietly reduce dollar exposure and increase gold and alternative reserve assets. The World Gold Council confirmed central bank gold purchases exceeded 1,045 tons in 2024 specifically. That was the third consecutive year of central bank gold purchases above 1,000 tons annually. This buying is directly replacing dollar reserves. It is the institutional equivalent of selling the dollar now. Poland, India, Turkey, and China have been the most aggressive gold accumulators in this replacement cycle. China specifically reduced its U.S. Treasury holdings to $682 billion, the lowest level since 2008 entirely. That capital moved into gold, yuan-denominated assets, and bilateral trade settlement systems outside the dollar framework. The Enbridge digital platform now processes real cross-border trade in digital yuan outside dollar infrastructure. Iran has been charging yuan-denominated tolls for oil shipments through the Strait of Hormuz directly. These are not theoretical future scenarios. They represent the active operational erosion of dollar dominance. The petrodollar system that has underpinned dollar demand since 1974 is visibly and measurably fracturing. That 1974 agreement ensured global oil transactions occurred in dollars, creating permanent structural dollar demand. As oil begins trading in alternative currencies, that structural demand base for dollars systematically shrinks. Every barrel of oil settled in yuan or rupees is one less barrel supporting dollar demand. Oil is currently priced at approximately $104 per barrel following Middle East conflict disruptions globally. At that price level, the dollar amount involved in oil settlement is enormous in daily volume. Even a modest shift in the percentage of oil settled outside dollars has massive currency market implications. Morgan Stanley's bearish dollar view incorporates this petrodollar erosion as a structural medium-term headwind entirely. Now look at the immediate economic environment that the dollar is weakening into specifically. American consumer confidence just hit 47.6 in the April 2026 University of Michigan survey results. That reading is the lowest in the survey's entire 74-year recorded history, without exception. Consumer confidence at this level signals that American households are cutting back on spending and saving. When consumers cut spending, GDP growth slows, and slower growth further reduces dollar appeal to investors. The Eurozone composite PMI fell to 48.6 in April 2026. Below the growth contraction threshold. But Europe's monetary policy trajectory is diverging sharply from America's, and that divergence matters enormously. ECB rate hike probability reached 72% in futures markets due to Middle East energy inflation. The European Central Bank hiking rates while the Federal Reserve cuts rates is the most dollar-bearish scenario possible. Interest rate differentials drive currency flows, and this particular differential strongly favors euro over dollar. A hiking ECB and cutting Fed combination will accelerate the EUR-USD move toward 1.18 significantly. Rabobank's 1.18 EUR-USD target may actually prove conservative if this rate differential widens further than expected. Morgan Stanley acknowledged this rate divergence risk explicitly as a key driver of its bearish dollar outlook. Now consider what a weaker dollar means for inflation inside the United States going forward directly. A falling dollar makes every imported product more expensive for American consumers and businesses immediately. America imports approximately $3.1 trillion in goods annually, according to Census Bureau trade data figures. Every 1% decline in the dollar raises the cost of those imports by roughly $31 billion. If the dollar declines 5 to 10%, as Morgan Stanley projects, import cost increases become enormous. Oil, already at $104 per barrel, becomes even more expensive in dollar terms as the dollar weakens. Food imports, electronics, clothing, vehicles, and industrial components all carry higher price tags simultaneously. This dollar-driven import inflation arrives directly on top of already elevated energy inflation from the Hormuz disruption. The Federal Reserve faces an additional impossible dimension. Cutting rates weakens the dollar and fuels inflation. Holding rates steady slows growth further and worsens the already 74-year low consumer confidence reading. Morgan Stanley has essentially identified a policy trap where every available Fed tool carries serious costs. That trapped policy position is itself a dollar-bearish signal, because trapped central banks lose credibility. Central bank credibility is the ultimate foundation of currency confidence in a pure fiat monetary system. When the Fed appears trapped and credibility is questioned, foreign investors reduce dollar exposure as protection. This reduction in foreign dollar demand adds yet another directional pressure to the Bloomberg Dollar Index decline. The geopolitical dimension of dollar weakness carries its own distinct financial weight that deserves careful attention. America experienced its third presidential assassination attempt at the Washington Hilton on April 25, 2026. Political violence at that level is classified by institutional investors as a foundational credibility event. When foundational credibility events occur, capital moves immediately from the affected currency towards safe haven alternatives. Gold surged following the Washington Hilton incident, confirming the classic political risk safe haven rotation pattern. The dollar weakened further, adding to the existing 4-year low trajectory already established before the attack. International sovereign wealth funds and central bank reserve managers recalibrated American exposure in real time. That recalibration is not panic. It is professional risk management responding to measurable institutional stress signals. Morgan Stanley's dollar forecast was published before the assassination attempt, meaning subsequent events add further downside risk. The dollar's weakness is not a single cause story. It is a convergence of forces. Each force is significant individually. Together, they create a powerful and sustained directional pressure downward. Morgan Stanley identified the dollar as historically overvalued before any of the political shocks arrived. That baseline overvaluation was already sufficient to justify a structurally bearish medium-term dollar outlook entirely. Every subsequent development in 2026 has added additional downward pressure on top of that baseline. The third assassination attempt on Trump added political risk premium that currencies absorb immediately and measurably. The Middle East war pushed oil to $104, increasing America's import bill in dollar terms. The ECB, moving toward rate hikes while the Fed cuts, creates the most bearish dollar differential possible. Consumer confidence at 47.6 signals domestic demand weakness that reduces dollar appeal to foreign capital. Every single development in 2026 is pointing in the same direction, and that direction is down. Now, examine what dollar weakness means specifically for American households in their daily financial lives directly. This is not an abstract institutional story. It lands in every grocery store and gas station. America imports approximately $3.1 trillion in goods annually, according to U.S. Census Bureau trade statistics. A 10% dollar decline raises the cost of those imports by roughly $310 billion annually. That $310 billion does not stay in corporate balance sheets. It passes directly through to consumers. Retailers like Walmart and Target have already warned customers about incoming price increases from trade policy. A weakening dollar adds an additional layer of price pressure on top of existing tariff-driven inflation. The Federal Reserve's preferred inflation measure, PCE, was already running above the 2% target. Dollar depreciation of the magnitude Morgan Stanley projects would push PCE inflation measurably and persistently higher. Higher inflation forces the Fed to reconsider its rate-cutting trajectory, creating exactly the trapped scenario described. If the Fed pauses cuts to defend the dollar, consumer spending and business investment both contract further. If the Fed continues cutting to support growth, the dollar falls further and inflation accelerates upward. This policy dilemma is the precise mechanism through which dollar weakness becomes an economic amplifier. It makes every existing problem, debt, confidence, energy costs, measurably worse for ordinary American households. Ray Dalio identified this exact dynamic years before it materialized in his Changing World Order research. He called it the terminal phase of a long-term debt cycle. Currency debasement becomes unavoidable. Bridgewater's portfolio positioning, reducing dollars, increasing gold, reflected that forecast with full institutional conviction. The current dollar trajectory validates Dalio's framework more precisely than even his most detailed models predicted. Morgan Stanley's bearish dollar call is arriving at the exact moment Dalio's debt cycle thesis accelerates. That convergence between institutional analysis and actual market behavior is the clearest signal available right now. Now look at what dollar weakness means for America's $38 trillion debt burden going forward specifically. America issues treasury bonds denominated in dollars, meaning dollar weakness does not reduce the nominal debt load, but dollar weakness does reduce the real purchasing power of interest payments received by foreign bondholders. Foreign bondholders, who receive interest in weakening dollars, are receiving less real value with every payment. This reduced real return makes U.S. treasuries less attractive to the foreign investors who buy them. Less foreign demand for treasuries means the U.S. government must offer higher yields to attract buyers. Higher treasury yields increase America's borrowing costs on its existing and future $38 trillion debt load. The Congressional Budget Office already projects interest payments consuming 27% of all federal tax revenues. Higher yields accelerate that consumption, leaving less money for defense, healthcare, infrastructure, and every other priority. Goldman Sachs flagged this exact feedback loop in its analysis of American fiscal sustainability going forward. Dollar weakness, therefore, does not just hurt consumers. It directly worsens the government's fiscal position. This is the fiscal currency doom loop that reserve managers and institutional investors are watching most carefully. When a country's currency weakens while its debt is rising, the combination becomes self-reinforcing very quickly. History provides uncomfortable precedents. The British pound's decline from reserve currency status took decades. Britain's post-World War II debt burden combined with structural economic weakness drove the pound's sustained decline. America is not Britain in 1945, but the fiscal mathematics carry disturbing structural similarities today. Morgan Stanley's call is not predicting a pound-style collapse. It is identifying a structural directional trend. That trend is gradual, measurable, and driven by forces that monetary policy alone cannot reverse quickly. Now consider what the international currency landscape looks like as the dollar weakens from its dominant position. The euro is the primary immediate beneficiary of dollar weakness in the short to medium term. EUR, USD, moving toward 1.18. As Morgan Stanley projects, means European assets become more expensive for dollar holders. American tourists in Europe, American companies with European operations, and American importers of European goods all pay more. The stronger euro simultaneously creates its own problems for European exporters competing in global markets now. European cars, machinery, and luxury goods become more expensive for non-European buyers as the euro strengthens. This export competitiveness challenge arrives at the worst possible moment for a contracting eurozone economy. Germany, already facing a 0.3 percentage point IMF growth downgrade, sees its export advantage erode further. France, already paying $59.3 billion in annual debt interest, sees its fiscal position under additional pressure. The dollar's decline is therefore not purely a benefit for Europe. It carries its own costs entirely. The Japanese yen story is equally complicated as the dollar weakens against major global currencies broadly. A weaker dollar means a stronger yen, which provides some relief for Japanese household import costs. Japan imports over 90% of its energy, so yen strength reduces the domestic cost of oil. But yen strength simultaneously makes Japanese exports more expensive in dollar terms for international buyers. Toyota, Sony, and Honda all earn substantial revenues in dollars that convert back into fewer yen. Japan's GDP is already projected at just 0.4% growth for 2026 by Deloitte economists. Any export revenue compression from yen strength pushes that already thin growth figure toward recessionary territory. Finance Minister Katayama's intervention warnings become even more complex when the dollar is already weakening structurally. Intervening to weaken the yen while Morgan Stanley projects a weaker dollar creates contradictory policy pressures. The global currency realignment driven by dollar weakness is simultaneously creating stress across it creates distributed pain across all trading partners. This distributed pain is precisely why the IMF titled its April 2026 report, Global Economy in the Shadow of War. The financial shadow is the dollar's structural decline, reshaping trade flows, reserve allocations, and monetary policies globally. Now the most important practical question: what should individual investors do given Morgan Stanley's dollar outlook? Gold at $5,100 is already reflecting dollar weakness combined with geopolitical and fiscal stress simultaneously. Silver's 120% gain in 2025 reflected the same dollar weakness and industrial demand convergence clearly. Commodity-producing countries like Canada and Australia see their currencies strengthen when the dollar weakens persistently. International equity exposure, particularly in markets with stronger currency trajectories, provides natural dollar weakness protection. Treasury inflation-protected securities provide some buffer against the inflation that dollar weakness typically accelerates over time. A 10 to 15% gold allocation, consistent with Ray Dalio's framework, addresses currency risk meaningfully. The investors who understood dollar weakness in the 2002 to 2008 cycle positioned in gold and commodities. Morgan Stanley's call is not a prediction of crisis. It is a forecast of a structural trend. Most investors realize the dollar at a 4-year low with Morgan Stanley projecting further decline. Dollar weakness is not a 2026 blip. It is a multi-year structural transition already measurably underway. The financially prepared investor is already adjusting. The unprepared investor is still waiting for more confirmation. If Finance Insight is delivering real value, subscribe now and hit the notification bell immediately.